So, on November 12th, the stock market basically developed a split personality. I mean, you had one side celebrating all-time highs, while the other was just quietly slipping into the red. Today, we're going to explain what on earth happened and, more importantly, why it really matters.
And that's the big question, right? How is it even possible for the Dow, which is like America's industrial core, to be surging while the tech-heavy Nasdaq just falters? Let's really get into the specifics of this divergence.
The numbers themselves paint a super clear picture. You've got the Dow Jones just packed with those industrial giants, climbing up to a new all-time high. But then you have the Nasdaq, home to all our favorite tech innovators, and it actually went down. This is the split we're here to understand.
To really get this, you have to look under the hood of these two indexes. The Dow represents the bedrock of the economy. We're talking stable industrial companies. The Nasdaq, well, that's the playground for high-growth tech stocks, often valued on what they might do in the future, not just current profits. They just operate on completely different rhythms.
So, what's causing this whole thing? What we're witnessing here is a classic case of what's called sector rotation. You can think of it like a massive tide of money that's just flowing from one part of the market to another. Let's dig into what's driving this big shift.
Okay, so there are 5 key forces really pushing this rotation. First, the government shutdown ended, and that boosted a lot of confidence in the broader economy. Second, that means delayed jobs and inflation data is finally about to come out, pushing investors towards companies tied to a real-world recovery. Third, after a huge run-up, investors are taking profits from the big tech names, the Magnificent Seven. Fourth, that profit-taking is making the AI-related stocks cool off a bit. And finally, with all this uncertainty around the Fed's next move, investors are just looking for safety in more defensive stocks.
And everything we just described, well, that's the textbook definition of sector rotation. It's not just random selling, it's a very calculated move by investors who are trying to get ahead of the next economic cycle. This quote really just gets to the heart of it all. The market is being pulled in 2 directions right now. Cashing in on the massive gains in tech, and this general feeling of caution about what the Federal Reserve might do next with interest rates.
So, when you boil it all down, what are the key takeaways from today's market action? Let's try to separate the real signals from all the noise. The first thing you have to understand is that today's split wasn't just random market chatter. No, this was a very clear signal.
This isn't some minor adjustment. This is a strategic reallocation of capital. We're talking about large investors who are rethinking risk and, for now, placing their bets on the more traditional foundational sectors of the economy. And ultimately, what this signals is that the market is preparing itself for a new phase. It feels like we're moving away from a period that valued future growth potential above everything else to one that values solid, real-world performance.
With all of that in mind, let's talk about what this means for you.
If you want to keep making sense of these big market shifts, make sure you subscribe. And you know what? Let me know in the comments which sector you're watching most closely right now. Your suggestions might just become the topic for our next explainer.